governments levy taxes so they can collect tax revenue to pay for public goods and services. The way that we calculate tax revenue is just the tax rate itself, which I abbreviate as T. So in our example, T was $3 a pack, times QT, which is the quantity of packs sold post-tax. So revenue is just T times QT. The tax, again, is just that green line, that's T. And QT is the quantity bought and sold post-tax. So base times height, the area of that salmon-colored rectangle, that is tax revenue. So in an example where the tax is $3 and the quantity post-tax is 500, 3 times 500 is $1,500. That's the tax revenue that the government would collect in this particular scenario. Now, notice also that the price that the buyer pays is a lot higher than it used to be, and the price that a seller receives is a lot lower than it used to be. So as you might have already kind of picked up, the consumer and producer surplus post-tax will be a lot lower. Remember, when calculating a consumer surplus, you're looking for the area below the demand curve, above the price paid, which in this case is just PB, and up to the quantity purchased, which in this case is QT. And when calculating or when visualizing the producer surplus, you want to look for the area above the supply curve, below the price received, which in this case, post-tax, is PS, up to the quantity sold, which in this case is QT. So you have a much, much smaller area for both quantity, a consumer surplus and producer surplus. Some of which they might get back in the form of public services. So we don't really treat that pink area as lost surplus. It's not really consumer, it's not really producer, it's just a transfer. But notice that there is what we call deadweight loss. Okay? Notice that post-tax quantity bought and sold is only QT, whereas pre-tax, the equilibrium quantity demanded and quantity sold was Q star. So, for each of these quantities in between QT and Q star, notice that the height of the demand curve remains above the height of the supply curve. Each one of these commodities in between QT and Q star, buyers are willing to pay a price above what sellers are willing to accept. So, presumably, pre-tax, there is a price in between, okay, this blue and red line that buyer and seller can agree on that will make them both better off for these transactions. But because of the tax, okay, these transactions don't actually occur. So, think of this gray shaded box as what we call a deadweight loss to society due to lost gains from trade. Okay? There are gains from trade to be had from these transactions, but because of the tax and the tax wedge, buyers are not going to be willing to pay the price required for these commodities, and sellers are not really willing to accept the prices that buyers are willing to pay for those commodities post-tax. So these transactions will never actually occur.